time now for Rick Ducat, lead market technician here on Options Corner. And so we're going to have some great conversations and trades and such. Good morning to you. I know you're taking a look at the charts here. Some of your thoughts.
Absolutely. Maybe not a household name, ARM Holdings, but an important company here. And when we look at the chart, we can see the price action has had a bit of a shift. First, you could have drawn a triangular shape between our two blue dashed lines here, but we've had a breakout to the upside that took us all the way up to this volume node area right here near about 180. Then we retreated. Now we're back within the thick of this other volume node near 162. Potential resistance at that old high point here near 173. Potential support down here near about 145 or so based on our moving average and our linear regression line, Nicole.
All right. So how about yesterday? What kind of action were you seeing yesterday, maybe in the options activity?
Yeah, for open interest on this one, I looked at the February 7th expiration because we have earnings coming up here. The top open interest on the call side was the 200, 170, and 180 strike calls. And on the put side, it was the 150, 120, and 140 strikes here. So you can see that the 180 and the 140 strikes match up with some of that volume activity. Now, if we could look at the biggest single trade of yesterday, the biggest trade was plus 1,250, February 21st, 115 strike puts at a 27-cent average debit here, and that was a 33,750 debit. Might sound small. This was almost certainly a closing trade, I think. The initial trade was for a $300,000 credit, so back of napkin math, $268,000 profit, potentially, if that is, our assumptions are correct there.
All right, Rick Ducat, thank you for that. Good luck at some of the options, and we appreciate it. Nice to see you. Let's continue taking a look here at ARM. Tom White joins us, senior options contributor, and you have an example trade ahead of the earnings. I'll tell you, I saw the KeyBank analyst thought it would come in line for the quarter. Guidance would be in line, had a 195 overweight for the price target. I'm curious to see what your example trade is for this winner, which is up 130% this year.
Yeah, nice run over the last, 12 months or so here in ARM Holdings. Now, expectations going into this report, the option market's priced in about a 9.5% move, about $15.50 either way for ARM Holdings. And we've seen some of the moves in some big tech companies post earnings, so that maybe that's expected once again here. So I looked at this on the basis of volatility dispersion as far as an example trade here in ARM Holdings, where near-term implied volatility levels really elevated at this point. And I want to take advantage of that. So if you're bullish on this name, where you think it's going to maybe go up that one standard deviation thereabouts of about $15.50 either way, this call diagonal to the bullish side takes advantage of that, where I'm going to go out to the February 21st monthly cycle. So 16 days to expiration, and I'm going to buy a slightly in the money call, the 162.5 strike call, and then against it in the near-term February 7th weekly cycle that expires in just a couple days, sell the 180 strike call. So a bullish $17.50 wide call diagonal to the upside here. Now, I'm going to pay about a debit of $8 if the stock opens up around 163. This will cost you about $8. There's your risk, $800 per spread. But you can see here from the risk profile that anything above about the 165 level is going to be profitability on this potential trade. $800 in risk, break even of 165 to the upside. It's a 2-week trade here. You're taking advantage of that vol dispersion I mentioned, where you're basically buying about an 82% implied volatility in the February 21st monthly cycle options, where you're buying that 162.5 strike call and then selling about 158 to 160% implied volatility in the near-term February 7th 180 strike calls. Now, this is definitely a bullish trade where you need the stock to move up towards that 180 strike. But as I mentioned, anything above that 165 level is going to be profitability on this. That vol dispersion where you're buying lower implied volatility, selling elevated implied volatility. Now, this is a bullish example. If you're more bearish on this name where you think it's going to fall, maybe a put diagonal to the downside might work in the same structure where you're buying basically an at-the-money put further out and selling the near-term options that are below the current share price. But as you get closer to expiration over the next couple of days, you'll have that opportunity to roll that or adjust that short 180 strike on the February 7th weekly cycle that expires on Friday. That collects credits, that increases potential profitability. But this is a type of strategy that takes advantage of the vol dispersion where you can get a lower price. So $17.50 wide call diagonal, that's bullish. You're only paying $8 for it, so less than half the width of that call diagonal. This might be the way to play it if you are bullish on this name going into earnings.
Thank you for that example trade. Good to see you, Tom White. Appreciate it.